30, and of course checking in on what's happening over in Europe. A lot of focus on the euro, given of course the headlines we've seen out of France, of course what this is going to mean for the ECB, Germany and some of the PMIs from there. 105.50 at this stage, and Japanese yen on the stronger side of 150 right now, 149.94. So let's speak about all of this with Chidu Narayanan, who is the head of Macro Strategy APAC at Wells Fargo Securities. Good to have you, Chidu. I suppose let's start from the top. We got jobs payrolls out on Friday, and now investors no doubt in a bit of a cautious mood ahead of the inflation prints out of the US. And all of this, what this is going to mean as far as influencing the Fed's next decision. And as we were just talking about and have been for the last week, such diverging views on just how linear or not linear that easing path is going to be for next year. How do you see things?
That's pretty accurate. We think we don't even know for sure that December is a done deal. It's close to. It's the closest it's been in a month with the strong payrolls. The payrolls was a bit of a Goldilocks number. It was strong enough to dissuade any worries of a collapse in or a complete slowdown in the US economy, but not too hot that it could feed through into higher inflation. So the focus is on the the inflation print that comes out next week. But for now, we think the Fed's possibly going to do a cut in December and then take it as it goes. Maybe not cut at every meeting, tweak their message quite cautiously, and again, remain very data dependent, data on inflation and on payrolls.
Right. I do want to get your sense in on how you see the resilience of the dollar, resulting in more weakness for the euro, pound, and other major currencies, the yen as well. Or do you think the yen will chart its own course because of what we expect the BOJ to do?
Right. I think that's been the theme of the year. I think the last probably 2-3 conversations that we've had have all centered around the strength of the dollar, and that's likely to be the theme near term. If anything, there's even more support for the dollar strength after events over the last couple of months. US data is still holding up, while you're seeing data elsewhere in Euro area, in China being quite a bit on the softer side. The Fed's cutting, yes, but not cutting as aggressively as was expected maybe 6 months back. And the dollar is going to be getting a boost from all of the risk events that play out. We've had the US elections, you have uncertainty over policy, uncertainty over geopolitics, uncertainty over tariffs, uncertainty over trade, all of which is going to be supportive for risk havens and for the dollar. So in that environment, we think the euro would underperform. We think the yen would certainly be outperforming. We still see the dollar yen going higher from current levels, possibly close to 155 by the middle of the year. But we do think that the yen would chart a slightly more stronger trajectory relative to its G10 peers.
What do you think the US actually wants? What do you think is the desired level of strength for the US dollar from the US's perspective?
There's been a lot of focus on the strength of the US dollar itself, and President-elect Trump looking for a weaker US dollar. But I think the focus is going to be on policy. Focus is going to be on foreign policy and on trade policy. The Fed's going to chart its monetary policy as a result of what happens with the data. If inflation is slowing down, if the job markets are soft enough, then possibly feel their way to neutral, because they're not really sure where neutral is. And the dollar is going to be impacted by all of this. We think that the dollar is probably going to be 5-6% stronger through 2025 from current levels, which is a fair bit of strength, coming both from the resilience of the US economy when everyone is weaker, but all of these risks. We think that markets are being a little bit complacent about the potential risks that are on the sidelines, a little less so than they were the last time we spoke about 3 months back, but still not yet comforting enough of a comfortable amount of risk being priced in. We still think that a soft landing scenario seems to be a bit more of a base case, and risks are more to the downside there.
Speaking of diverging views, where do you sit on the RBA rate debate, given that, of course, we've seen the Aussies have been sort of the holdout. We've seen the Aussie dollar, of course, now it's a 64 sort of range, and very much dependent on what we see over in China, of course, being that proxy. But you know, we've had calls from everything from they might go early as February to as far out as May. Where do you think the appetite is for the RBA?
Right. That's been a theme through this year again, and we've been probably on the opposite side for a while now, on the RBA being quite slow in jumping onto the rate cut bandwagon. A couple of reasons, and these haven't changed through the year. Growth in Australia down under is still quite resilient. It's slowing down, yes, but that's by design. They want it to slow down because inflation is still very sticky. It's not yet dropped off a cliff sharply enough that the RBA is going to be worried yet. And there's still a lot of fiscal support that's ongoing in Australia. The GDP number was soft, yes, and soft because of consumption. But the consumption data that came out just the day after was, again, showing quite a bit of strength in Australia. And not to forget, real rates in Australia are the lowest within the G10 space. So they did not hike as aggressively as all of the other peers did, which means that they're not in a scenario where they have to cut as aggressively as well. The Feb rate cut still remains on the table, but it's going to be very, very cognizant on what happens with inflation. That's the one number that the RBA is looking at, especially domestic inflation. For now, it looks like domestic inflation has sort of topped out, plateaued out at a very high level. A softer Q1, a Q4 print that comes out in Q1 will push the RBA to have a bit more comfort to maybe start cutting. Also depends on what the global scenario is like if the risks play out. But in terms of purely on the tariffs, we don't think RBA is going to, or Australia is going to be too affected. They'll be definitely affected by risk sentiment, but their trade exposure is a lot less than anywhere else in the world. Trade GDP is 45%, and they run a deficit with the US. So the US actually runs a surplus with Australia. And Australia exports commodities and raw materials, which really cannot be substituted, which means that the risk of direct impact of tariffs on Australia is on the lower side.
Okay. Chidu, the won, and how bad can it get, do you think, amid the political turmoil right now?
We think risks are for a much higher dollar won here. And this was even, say, 2 weeks back. Won's unfortunately fairly exposed. Domestic growth story is still quite soft. Consumption is picking up, but very, very soft levels. Leverage onshore is still on the higher side, especially on the household front, and they're very exposed to what happens in the external headwinds. If the dollar is going to be 5% stronger, the won's going to face a significant brunt of it, so probably about 7-8% higher. And this is also a scenario where we're talking about trade tariff risks. We don't know what the tariffs are going to be, and that's going to be a theme for H1 next year. If dollar CNH is going to be higher, increased trade tariffs, semiconductor cycle probably peaking out, that's not going to be giving too much of support as well. The ones was poised to be weaker. Add to all of this the political risks. It's going to be
So right now the won has lost about 2.3% over the last 1 week. Are you saying 7% in addition to this, or
no, 7% just before this? So we think the won
another
probably
5% to go, 4-5% to go.
So we think the won's probably ending the first half of the year at 1480, 1485 sort of levels, probably pushing up higher than 1500 by the end of the year.
So surprisingly, last week we had an analyst that actually put out a target of 1500 on the won, and initially I was taken aback, but that seems to be where the consensus is building, given a confluence of factors impacting the currency. What's your standout trade then for 2025? Where do you think, except for the dollar, can people make money in currencies, or is the dollar the only game in town?
That's a good question. I think dollar's been the game in town for 4 or 5 years now. It's likely to be still the game in town. But one way we'd like to express this lack of risk that markets are pricing on the FX side is pairing the yen and the won. The yen's a risk haven and is a bit more insulated to what happens on the global front. In fact, it might benefit as a risk haven if risk aversion increases. And the won, on the other hand, is facing all of the brunt. So we've been long yen won for a little while now, and we think that trade will continue to perform. So we like to pair outside of the dollar risks. Similar trade that we like is, say, CNH INR.